Welcome to This Explainer. Look, today we're going to absolutely pull back the curtain on the global financial machine. We so often look at the economy and think it's just this giant magic trick, or worse, that it's completely random. But the truth? Complex global economics is actually a series of highly logical, human-made systems. And understanding exactly how these systems function is literally the key to understanding what is happening in your wallet right now.
So, what if everything you thought you knew about money was actually wrong? Well, let's dive right into that. We're going to begin dismantling these everyday financial illusions you probably experienced on a daily basis. We'll be zooming way out to look at massive global concepts, and then zooming right back in to see exactly how they hit your personal bank account.
We've got a clear roadmap for this explainer today. We're going to cover 5 core areas: how money really works, inflation, deflation, and crypto, why everything costs more, building wealth versus trading, and finally, hiding the dirty money. All right, let's kick things off right away with Section 1, how money really works, beyond the paper. We have to start with a major illusion, which is the idea that a currency's value is just some random number printed on a piece of paper, or that somebody sitting in a room somewhere just arbitrarily decides what a dollar or a yen is worth. In reality, currency value reflects economic reality. A dollar, a pound, a yen, they're just numbers on a screen until you factor in what that currency can actually buy. Its value is a direct reflection of a country's trade balances, investor confidence, and just sheer economic strength. Exchange rates are constantly shifting because economies are always moving. Think about it like this. If Japan sells a whole lot of products to America, American companies need yen to pay those Japanese suppliers, right? That massive demand for yen pushes its value up. So a dollar might buy you 100 yen today, but depending on trade tomorrow, it might only buy 98 or maybe 102.
Now, here's where it gets kind of fascinating, because this totally dispels the myth that governments just fire up the printing press and print cash whenever they want to build roads or fund hospitals. Instead, they sell bonds. And a bond is basically just an IOU. You give the government $1,000 today, and they promise to pay you, say, $1,200 back in 10 years. This means countries are constantly borrowing and refinancing. They almost never pay off their full debts. They literally just sell new bonds to pay off the old ones.
And when you hear a massive number like the $36 trillion US national debt, it sounds absolutely terrifying. But wait, look at who actually holds that debt. It's owed to this incredibly vast web of lenders. It's owed to American citizens holding savings bonds, investment firms managing your retirement accounts, and foreign nations like China, which holds over $1 trillion in US Treasury bonds, and Japan. Countries are lending to each other constantly. And you know what? This system functions quite smoothly as long as there's economic growth and trust. Because after all, you can't exactly repo a country. Moving right along to Section 2, inflation, deflation, and crypto, trust and math. Let's look at what exactly happens when that crucial trust in a currency starts to waver. This brilliantly illustrates why a government can't simply print its way out of trouble. Imagine a tiny town with just 100 people and 100 loaves of bread. Everyone has $10 and bread costs $10. Supply perfectly matches demand. But if the government just prints another $1,000 and hands it out, the bread supply hasn't changed at all. Suddenly people rush to buy bread, the baker realizes everyone has more cash, and boom, prices shoot up to $20, then $30. The extra money didn't make anyone richer, it just diluted the value of the cash. Printing money without actual economic growth simply prints inflation. This is exactly what happened in 1923 Germany, where people literally needed wheelbarrows full of cash just to go buy groceries. Okay, so the crucial point here is that while inflation is painful, falling prices, deflation, is a straight-up economic paralysis. I know, it sounds great initially. Cheaper groceries, cheaper cars. But if you know for a fact that a $30,000 car is going to cost $28,000 next month, you delay spending. Businesses see their sales drop, so they cut prices even more and start laying off workers. Unemployment rises, people spend even less, and the whole economy spirals downward. And here's the kicker. Debt becomes absolutely crushing. If you have a $50,000 business loan, you still owe $50,000, but now your revenue is shrinking because your prices are dropping. This exact trap is what caused Japan's economy to stagnate for decades back in the 1990s. So, since traditional money relies so heavily on having trust in a government to manage this delicate balance of inflation and deflation, it brings us to a really fascinating alternative. An alternative that attempts to replace human trust with pure math: Bitcoin. Let's put them side by side for a second.
Fiat currency, like the everyday dollars in your bank account, requires trust in central authorities who control it, and as we've seen, can print more of it. Bitcoin, however, relies on a decentralized public ledger called a blockchain. So instead of a bank, thousands of computers all over the world, called nodes, solve complex math to verify every transaction. No single person controls it, and it's hard capped at 21 million coins. That means scarcity is built directly into the code itself. But, it's definitely not perfect. Bitcoin transactions are pretty slow compared to just swiping your credit card. The price swings wildly, and because there's absolutely no central authority, if you lose your password, your money is literally gone forever. There is zero customer service to call.
Which brings us to Section 3, why everything costs more, tariffs and housing.
Let's look at how these massive macroeconomic concepts build up and trickle right down to your daily shopping cart and the roof over your head. When you hear about tariffs on the evening news, it's so easy to assume the foreign country is just writing a big check to our government. But, as this quote perfectly states, the foreign country doesn't pay a cent. You do. Think about it. If the government slaps a 25% tariff on $1,000 worth of Chinese steel, the U.S. government charges the American importer an extra $250 right at the border. The Chinese supplier? They still get their full $1,000. So the American company now has a choice: lose profit or raise their prices. And almost always, they raise prices. That extra $250 gets passed quietly right down the chain until it reaches you, the final consumer, buying a car or an appliance. Ultimately, tariffs are just taxes on imports, and the end user always foots the bill. Now, this number is just staggering. Back in 1970, the average cost of a home was $23,000. If we just adjusted that for normal inflation, a house should be about $170,000 today. But actual home prices now average over $400,000. So why the massive disconnect? Well, wages simply haven't kept pace, for sure. Plus, we're dealing with severely restricted supply thanks to complex zoning laws and local neighborhood resistance. Add in historically low interest rates that made borrowing incredibly cheap for years, and Wall Street investors sweeping in to buy out properties, treating homes as portfolio assets rather than, actual shelter. And you can quickly see exactly how regular, everyday buyers have been completely priced out of the market.
All right, Section 4, building wealth versus trading, the long game.
Now that we've mapped out exactly how all these costs get passed down to us, let's pull back the curtain on how people actually build wealth over time. Because it is absolutely essential to understand that trading and investing demand completely different mindsets. Trading is a high-stress sprint. It's all about reading short-term charts, betting on volatility, and riding momentum to make quick cash. But the reality is most traders actually lose money because trying to time the market perfectly is nearly impossible. Investing, on the other hand, that's a marathon. It relies on deep patience, the sheer power of compound interest, and having the stomach to endure market crashes, knowing that historically markets do recover. This long game is exactly how Warren Buffett built his absolute fortune, finding quality companies and simply holding on to them for 30 or 40 years. This is honestly one of the market's deepest, most fascinating secrets: how debt is actually utilized. For the average person, debt usually means high-interest credit cards or student loans. It's a massive drag on wealth. But for the ultra-wealthy, debt is actually a tool for immense growth and completely legal tax avoidance. Let's say you have $10 million in stock and you sell it to buy a luxury house. You're going to pay millions in capital gains tax. But if you borrow against that stock, using it as collateral, the bank gives you a super low interest loan, maybe at 3%. Meanwhile, your stock continues to sit there and grow at 10%. So you get the cash to live on, your assets keep growing way faster than the cost of the loan, and because you technically didn't sell anything, you avoid the taxes entirely. It's wild.
And finally, Section 5, hiding the dirty money inside the wash.
Let's take a look at the dark side of this financial machine and how criminals manage to manipulate the exact same complex systems we've just been talking about. A criminal can't just stroll into a bank and deposit millions of dollars in drug money without raising some massive red flags, right? So they use a structured three-step process. First up is placement, breaking the cash into tiny, unnoticeable deposits or converting it into physical assets like expensive cars. Second is layering, transferring the money through incredibly complex webs of offshore accounts and shell companies just to bury the paper trail. And third is integration, bringing that money back into the legitimate economy by investing it into cash-heavy businesses like restaurants or car washes. They just report inflated earnings, mixing their dirty money right in with the real revenue.
And the crazy thing is, once it runs through those 3 stages, they simply pay taxes on it. And suddenly, drug money looks exactly like a totally legitimate paycheck. The global financial system is just so incredibly massive and complicated that by the time the cash is sliced, moved around, and reassembled,
The dirty money completely disappears into the daily noise of millions of normal-looking transactions. The money is sitting right out in the open. It's the crime that is hidden. We have covered a massive amount of ground today, stripping away the illusions around debt, inflation, trade, and wealth. You now possess a much clearer view of the exact levers and gears that are running the global economy right under our noses every single day. Knowing how the game is actually played is the very first step to making it work for you. So armed with this new understanding, what moves are you going to make next? Thank you so much for joining me for this explainer. Keep asking those big questions, and I'll see you next time.